makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua at the ECB Forum on central banking here in Sintra, Portugal, and these are your top stories. Bloomberg understands the EU is willing to stomach Donald Trump's 10% universal tariff, but with some exemptions. The U.S. president threatens Japan. Trump's $3.3 trillion tax and spending bill faces roadblocks as Senate Republican leaders continue to scramble for votes. And here in Sintra, Jay Powell will speak with other top central bankers as the White House steps up attacks on the Fed chair. Now, Bloomberg has learned that the European Union is prepared to accept President Trump's proposed 10% universal tariff, but it wants exemptions for key sectors in return. Now, the EU has until July 9th to clinch a trade arrangement before tariffs on nearly all of the bloc's exports to the U.S. jump to 50%. Well, we're now joined from London by Oliver Crook and Roz Matheson, our EMEA news director. So, Ollie, let's start with you. What do we understand about the EU position going into these negotiations in Washington this week?
Yeah, it seems to be that they have sort of come to peace with the fact that that universal 10% tariff is something that the Trump administration is effectively, basically totally unwilling to negotiate on, which is something that, arguably they should have come to the realization a lot earlier, because this has been fairly clear from the outset in terms of these negotiations. What they would like in return, that means that they're willing to accept in their minds some kind of unfairness and imbalance in the relationship. What they would like to see in return is a reduction slightly either through quotas or a headline reduction to the current tariff that exists on the automobile sector. That's now at 25%. They would like to see that come down, but they also want to get clarity on some of the other sectors that are still being investigated by the Trump administrations. For the Europeans, the ones that are the most important are the pharmaceutical industry, the chip sector, and the aircraft sector in terms of planes and getting those tariffs. Because what they're doing now, until they have clarity in those other sectors, is basically paying a down payment on something that they don't fully understand. So they'd like to get clarity on that. That's how they would like to make progress. And that is, of course, ahead of that deadline that is July the 9th, where we're expecting, if there is not a deal, that the Trump administration will impose those 50% tariffs on the European Union.
So, Ollie, what's at stake if these 50% tariffs are actually imposed?
Yeah, whenever you speak to sort of trade ministers and finance ministers, as I have over the last couple of months, when you talk about a figure like 50% tariffs on goods from the European Union, that is basically a sum which of the impact on the economy is entirely incalculable. Just to remind people, this is, a $1 trillion trading relationship. It's the biggest in the world. Very much is at stake both for the United States and for the European Union, which is why they're going to take their time in negotiating this, so an outcome that both sides can live with. That is why I suspect, I'm not sure that we're going to get that full trade deal by July the 9th. Plus, you look at the sort of first 4 months of this year, the trade deficit with the United States and Europe has completely blown out, because everybody has been trying to get those sort of goods in and out of the sector before the tariffs come into action. So I suspect what you're going to get is potentially a sort of broad agreement, maybe some consensus, but really get that negotiation that goes past July the 9th. And I think that's probably the base case for a number of European policymakers.
So, Roz, what's the status of the other trade deals?
Well, what we're seeing, interestingly, is suddenly Japan is the country that's in the crosshairs. It was Canada a few days ago over this digital services tax, announced Japan over rice, and Donald Trump really putting his focus there and saying, hang on, Japan won't take any of our rice, and yet they've got a rice shortage in Japan. And that's leaving Japanese officials scrambling to work out how to respond. Of course, Donald Trump had a great relationship with the former Prime Minister, the late Shinzo Abe, but he doesn't have that anymore. And so who does he go to in Japan to get a deal done? And how does Japan engage with him to avoid being the one country that really gets his eye here? Is rice the new digital services tax? And so what we're hearing is that Japanese officials are playing it very low key at the moment. They don't want this to spark into a big public argument, but they're a bit perturbed. How can they respond in a way that will satisfy Donald Trump? Because agriculture, rice, is a really sacred industry in a way in Japan. I mean, decades and decades of protecting agriculture, and particularly protecting rice farmers. That's bound up in a lot of identity culture, but it's also, frankly, bound up in votes for Japanese governments. And so that's got to be a factor for them. And so now suddenly Japan is the country out of all that seems to be having the problems.
Roz, if we also touch on what's happening on Capitol Hill, senators are voting on Donald Trump's signature tax and spending bill. Like, where are we? This seems to be going straight to the wire, right to the wire.
Well, yeah, so it could go very much into the US morning. It's ongoing, an awful lot of amendments, most of which have no chance of getting up. But there are some key issues here that remain. And so far, it seems there are at least two senators who are adamant in their opposition to this bill. If one more peels away, then Donald Trump has real problems in the Senate getting this passed. And there are fundamental disagreements, mainly at this point, over the pace of which to roll off some of these green credits. This is for EVs, for renewables and so on, at what pace to do those to help those industries. And so that's where we are at this point. There could be maybe an up and down vote later today, but it's bound in a lot of amendments and disagreement at the moment. And we can see that even Elon Musk is now weighing in again. Of course, he and Donald Trump had a massive dust up a few weeks ago. They papered over that dispute where they were really shouting at each other on social media. They've both been up in the wee hours taking pot shots at each other, to the point that Donald Trump is saying, well, hang on, Elon Musk has benefited a lot from these subsidies. I don't like these subsidies. And perhaps I should have Doge have a look at Elon Musk in all of this. So that feud is bubbling away again, it seems, on the sidelines of this. And we're seeing an impact on Tesla stock going into the US day as a result.
Thank you both, of course, for the terrific update, Ross Matheson and Oliver Crook. Now, the U.S. Treasury Secretary has also played down speculation that President Trump could name a new Fed chair early, suggesting a name may not emerge until October or November. But Donald Trump is also continuing to put pressure on Jay Powell to lower rates.
The president sent this note to the Fed chair. It says, Jerome, you are, as usual, too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars are being lost, and there is no inflation.
And the Fed chair will be among the central bankers who will be on a policy panel that I'll be hosting a little bit later on. Now let's bring in Adam Posen, the president of the Peterson Institute for International Economics. Peter, thank you so much for joining us. Adam, thank you so much for joining us. Look, there's quite a lot going on, right? And I have to say that Jay Powell is constantly under threat. Do the markets, care or wake up to the fact that the next Fed chair could be a little bit different?
I think the markets are making one mistake and one mispricing, Francine. I mean, the mistake is they are too dismissive of the idea that Trump could actually try to disrupt the Fed not just who he appoints, but try to disrupt its operations in a more aggressive way. I think the mispricing, though, is not understanding that the threat from a bad next Fed chair, to be blunt about it, is not so much about short-term inflation. It's about making the wrong decisions or getting incoherence in the committee at a critical point. So if it turns out there's high inflation, which I still think there's going to be, it really doesn't matter who's Fed chair. They will raise rates. If it turns out AI starts to come in, the fiscal starts to expand, and it's unclear what's going on, that's when having a bad Fed chair gets to be a problem.
But Adam, is there a danger actually with the constant, pressure from President Trump that actually Jay Powell, skews policy because he needs to be seen as independent? It's like the ABC of central banking.
Yeah, of course. But there, I think the markets and everybody get it right. Chair Powell is independent. The courts have curtailed the independence of the Fed, but not specifically with respect to monetary policy. And ultimately, he's the chair of the FOMC by vote of the FOMC. The president only gets to appoint the chair of the Board of Governors. The person who's chair of the FOMC has to have the support of the full committee, including all the 12 Reserve Bank presidents. And Jay Powell has that support. Most of all, Jay Powell understands the institution. I may disagree occasionally with him on regulation or on a specific monetary policy move, but he's devoted to rule of law. He's devoted to the independence of the institution. He's devoted to being a fair umpire.
Yeah. But when you look again at market moves, I think last week there was talk about having a shadow Fed chair, and markets moved on the back of that.
Which is noise. Again, the question is, does the shadow Fed chair, if they create one, which Scott Bessent floated before the election, as you know, starts to really try to interrupt the news flow out of the Fed, tries to create confusion. So if the shadow chair tries to be obstructionist, again, ultimately it's not going to change policy, but it will create noise.
Okay, what else is noise out there? When you look at markets, expectations, and now also the trade concerns with Japan,
right.
Is it noise, or could actually these trade negotiations change the trajectory of a lot of economies?
I think the Japan negotiations actually are very significant because, Francine, they're the most surprising holdout. The idea that China or the EU would bargain hard with the US always made sense because they're the most diversified and largest. But Japan always, one would have thought, would be like the UK because of the deep economic, national security, political ties that they would want a deal no matter what. And if it turns out Trump cuts Japan a much worse deal than he's supposedly offered the UK but isn't implemented yet, that's a really negative sign for the rest of the world. So I think more attention should be being paid to the Japan negotiations rather than less.
I mean, how should the BOJ deal with this?
That's much harder. I mean, as you mentioned, we're going to have a panel later today with Andrew Bailey, Jay Powell, Kazuo Ueda, and Christine Lagarde. And Governor Ueda and the BOJ have a real dilemma. And because the tariffs are, or the threat of tariffs are creating a recessionary dynamic in Japan, but it's really stagflation because they've got rice and other things driving up the prices. So they're on the horns of a dilemma. I think, like Powell, they're in the end going to try to do the right thing on the economy and block it out. Yeah. But you have to allow for the fact that there's real shocks coming for Japan. Yeah.
But so, again, if you think about the BOJ, none of the options are good.
No.
What would you do if you were in charge?
I think I would do largely the same as what they're doing right now, which is staying on their very slow rate hike path. I would back off some of the discussion of normalization, which that rhetoric still keeps coming back, and not so much because they're worried about the fiscal sales, but because the outlook now, if anything, I think is more negative. They stand a real chance of an externally shocked recession.
Adam, I want to come back to your inflation expectations in the U.S. Why are they so slow to materialize?
I don't think they're that slow. I admit that having 4 months in a row of inflation prints that were a little below consensus and below where I was thinking is information. But as Fed Atlanta President Raphael Bostic said in a speech I think yesterday, there's just plenty of reasons why there might be a lag, including just literally, and we know this from the auto industry, that they were burning through present inventories. And once those inventories are gone, you're now seeing prices go up. Now, the MSRPs, the official sticker prices, are not, but all the major companies, even Ford, are lowering incentives, lowering the financing deals, lowering the availability of certain models. These are all forms of inflation. And the actual price transacted is going up. These tariffs are already hitting the U.S. auto industry. It's harming supply chains. It's causing inflation that we're already going to feel.
So without the tariffs, either a threat or real, do you think the Fed would have cut rates?
I think they might have, but I think it would have been a mistake because even if the tariffs aren't there, but they are, the anti-migration policies in the U.S. are also inflationary, if not stagflationary. The fiscal policies we're going to get, you talked with your colleagues about that bill's going to pass. And so the only question is just how much short-term stimulus does it hold? But the bias is going to be to the upside because people are going to stop paying taxes. There's less enforcement. So ultimately, I think, and this is something you and I talked about over the last year, I think the Fed is understandably but making an incorrect forecast. The forecast is more likely to be inflation than not.
Okay. The ECB has an easier job. Yes. Actually, they did okay.
Yeah.
But what would it take to go into, to cut another? If you cut, it starts becoming stimulative.
Yeah, and again, I think if the ECB makes this deal that we're talking about with Trump, which is not optimal, but medium term is probably smart for Europe, and sorry, it's not the ECB, it's the European Commission. Yeah. The ECB should basically stay on its path. And I agree with you. The ECB of the major central banks has by far the easiest situation right now. And rightly, a lot of the attention now is being paid to digital euro, stable coins. I mean, these are things that used to be solutions in search of a problem. Yeah. Well, now we have the problem, which is reduced faith in U.S. treasuries. And so Christine Lagarde and a number of the other ECB leadership, governing council, are right to be focusing on that issue now.
I mean, apart from gold, there doesn't seem to be an alternative, actually, for central bankers around the world.
Yes and no. I mean, you can get into small other currencies, relatively small other markets like Japanese yen, Swiss franc, Norwegian krona, but of course those get overbought very quickly. They're not as liquid. You can issue more debt in Europe. That's the best way out for everybody, essentially. And that's, of course, out of the ECB's control. But I think they're right to indirectly and directly say deepening European capital bond markets, capital issuance is a good thing.
Adam, thank you so much for joining us today. That was, of course, Adam Posen, president of the Peterson Institute for International Economics. Now, coming up, our interview with the chief executive of the S&P Dow Jones Indices as U.S. stocks end the first half at a record high. That's next, and this is Bloomberg. Welcome back, everyone. Now, U.S. stocks have ended the first half of the year at a record high. Now, equities have soared since April's meltdown. That's amid hopes that the U.S. is moving closer to reaching deals with top trading partners. Well, let's get more with Guy Johnson in London with a guest. Hi, Guy.
Yeah, it's only at a record high if you're a dollar investor. If you're a euro investor, the picture looks very different. So let's discuss that aspect of what we've seen over the last quarter. Dan Draper, CEO of S&P Dow Jones Indices, joining me around the table. Good morning. Nice to see you on this side of the Atlantic.
Hi, Guy.
The perspective from different sides of the Atlantic looks very different. If I'm a US investor, the S&P's had a great quarter, done really well. Markets have bounced back from the lows. If I'm a euro investor, I'm looking at a pretty big headwind here, and actually I'm not at record highs. Are we moving into a different position now when we think about US markets, and that is one that has to be currency adjusted?
Yeah. Well, I think, yeah, as you mentioned, I mean, the U.S., if you look at the S&P World Index that we have, global equities, yeah, U.S. equities still are about 64% of that index. So it's a still big constituent. But what you've had is the currency movement you've been reporting on, continuously, has been sharp. I mean, this is over a 10% decline in the dollar versus a basket of other currencies. That's the biggest decline since 1973. Right, going off the Bretton Woods gold standard. So that's a big movement. Hasn't been it's kind of been done over a couple of months here, but that adjustment has made the market less attractive. But overwhelmingly, what's kept the market high are the domestic wealth management investors in the United States. As foreign investors, when the dollar started weakening in April, started moving funds to Europe, Asia, to the home markets, those were institutional flows, more than made up by domestic flows.
And is that something that you think is going to carry on? Because the retail investor, we're getting to a story where you used to never bet against the US consumer. Now do you never bet against the US retail investor, because that demand has been insatiable. There's a lot of muscle memory that exists from the last few years. If there's a dip, you buy it. There's an opportunity there, you take it. Is that something you think is going to be tested, or do you think we're still in that kind of a world?
Yeah, well, just on the U.S. domestic market, what has changed among wealth and retail investors is the rise of fee-based model portfolios. Over half of ETF inflows last year, and certainly on track this year, will go into these model portfolios, which automatically rebalance. The Vanguards of the world and others who provide the robos. So that is kind of give more systematic dollar cost averaging. Now, I think looking, like I said, abroad, you have the U.S. earnings, the companies that are, compared to, say, the dot-com bubble where you had a lot of promises but didn't deliver on earnings. The tech giants that are delivering, the performance now, certainly in the last 2 months, are also delivering earnings. U.S. earnings reported in Q2, 77% of the reported companies have outperformed. That's versus 73% historically. So you're starting to see the delivery. Where can you get that earnings growth and momentum in the world? Again, it's the U.S. is kind of leading, again, offset by the weaker dollar for foreign investors.
Does the market feel too narrow, though? That's always been the concern. And you look at the fact that the S&P outperformed the equal weight over the last quarter.
Yes.
That tells you the market's a little tight, maybe.
Yeah. Well, if you look at Q1, when there was fear, obviously you moved to a very defensive posture in the equity markets. You did see the momentum trade, the concentrated, Mag 7, massively underperform. The equal weights, but even defensive sectors, low volatility equities. So you saw that if we face another correction period, you're going to see the underperformance. But as you've now seen the more normalization, momentum, the S&P 500 momentum index has outperformed substantially the last 2 months, the normal S&P 500. So momentum is a strong factor, and it seems to indicate, and particularly when you close at all-time highs as we did yesterday, there's a 92% chance historically, looking backwards, that you're going to have another all-time high within the month.
Okay. In terms of the scenarios you see going forward from here, does volatility pick up? Momentum is great when you have a reasonably stable environment and that kind of trade works. But do you think we are moving into or are in a more volatile period, despite the fact we've got the VIX at kind of 16, 17 right now?
Well, clearly, we live in a world of headline volatility, right? Every day and intraday. But if you look, the VIX index, which we look at, has come back down to 17, 18. So it's kind of, mean reverted to closer to historical levels. But beyond that, implied volatility, looking forward, and dispersion are actually reasonably high. So that means that, arguably, if you're looking to tactically rotate or even, frankly, active management, this should be with the higher dispersion levels. And again, that won't be seen in the VIX itself. Those are still elevated. So again, the negative sentiment, that is still overhanging the market is actually, I think, a positive, considering we're closing at all-time highs. There's not a crowded trade, at least sentiment-wise, in these closing highs.
In terms of the rest of the world now, do you think we are going to see a more diversified, balanced world going forward? We've been through such a period of US exceptionalism. Can we stretch that model any further? Or do you think actually we end up in a position where we do see some of the narrowing that we've got? US equity markets are trading on, 23, 24, kind of really high multiples. Europe's trading on 14, which is high for Europe. But nevertheless, we've got this incredible kind of gap that exists across the Atlantic. Do you see a world in which that does start to narrow, that does start to even out, that we see more even flows around the world?
Well, again, if we go back to kind of Q1 and certainly with the April original tariff announcements, you did see valuations matter, and you saw kind of the mean reversion. You saw flows, and you obviously saw the outperformance, certainly in local currencies, Europe, emerging markets. So those valuation gaps did close. I think the U.S. exceptionalism, it's the entire capital markets ecosystem. If you start with the venture capital into private equity, all the way through the listed companies, and what's emphasis, these aren't just necessarily U.S. companies. It's the foreign growth companies that are listing in the United States. So if you are a tech, communication giant or a unicorn and you want to list, you're increasingly looking to list New York Stock Exchange, NASDAQ. And so it's bringing even global companies into those listed markets.
Do you think America wants everybody else's capital, though? I think it has done. Does it continue to want it? Because the flip side of the trade story is a capital story.
Yes.
And if you change the trade story, you change the capital story. Can you see a world in which trade does get more restricted and therefore capital does get more restricted? Is that a desirable outcome, do you think?
Well, look, I think balances, matter over time. And again, we saw when there was kind of the fear in early April, that became an issue, right? You saw, kind of the inflationary worries, the steepening of the yield curve, and the focus on the U.S. fiscal imbalance, right? So being able to think about when you have such a large consumer-based economy, the offsetting kind of capital flows, the financing of that, that's what we've been in. The question is, does that, break over time? And again, we've seen over shorter periods when there's been that dislocation.
We will watch with interest.
We shall.
Dan, great stuff. Thanks for dropping by to see us. Dan Draper, the CEO of S&P Dow Jones Indices. Back to you in Sintra, Francine.
Guy, thank you so much. Guy Johnson speaking, of course, with the chief executive of S&P Dow Jones Indices. Coming up, we speak to the chairman of Société Générale, Lorenzo Bini Smaghi. That's next. We have a full roundup, of course, of the markets. We talk trade, and that's ahead of our big policy panel here in Sintra. That's at 2:30 UK time, 2:30 Portugal time, where we'll be speaking to Andrew Bailey, Christine Lagarde, Jay Powell, of course, Governor Ueda of Bank of Japan and the governor of Bank of Korea. They all have very different trajectories when it comes to inflation, when it comes to growth. So don't miss the policy panel live from Sintra. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the ECB Forum on Central Banking in Sintra, Portugal, and these are your top stories. Bloomberg understands that the EU is willing to stomach Donald Trump's 10% universal tariff, but with some exemptions. The US president threatens Japan. Trump's $3.3 trillion tax and spending bill faces roadblocks as Senate Republican leaders continue to scramble for votes. And here in Sintra, Jay Powell will speak with other top central bankers as the White House steps up attacks on the Fed chair. Now, earlier we spoke with the Bundesbank president and ECB Governing Council member. Of course, he is Joachim Nagel, who said the ECB has brought inflation under control but must not become complacent due to high volatile geopolitical backdrop.
Trade front loading is here the most important factor that gave us these good numbers for the first quarter. Now we have to take into account what comes from the tariff side, how this is evolving over time. And the point that I have here, we need, let me say, decision. We need more stability. We have to reduce uncertainty. And so I really hope that this tariff discussion is coming to an end, to a good end.
To a good end. How do you see it playing out? And again, because of the front loading, could you see it then fall off a cliff, or is it gradual, or is it just very difficult to model it?
If you want to bring yourself into the shoes of somebody who's doing an investment in a very uncertain world, when you think about the tariff discussion, I think for those we have to give clarity. We have to give them an orientation point where the tariffs are going. So I'm not putting like this that we are falling off a cliff, but financial markets, they need certainty. If there is uncertainty, then we see high volatilities. And so I guess it has to be of utmost importance to bring this whole discussion to an end, to a good end.
But given the uncertainty surrounding trade, could it still change the economic outlook for Europe?
Yeah, absolutely. It can change the economic outlook. I think if the tariffs are coming out at a very high level, I think this will be a burden on the economy. This is absolutely clear. And this is in a situation where you already alluded to that the economy in Europe is picking up. Taking my own country with the fiscal package, I think this year it looks around a little bit above zero growth, and then the next year we will see we'll see 0.6, 0.7, and then in 2027, maybe then it's maybe here 1.2 or something. So what I would like to say with this, that we are in a fragile situation, and when there is this, let me say, situation where we have this uncertainty and you are in a fragile situation, this is a burden to the economy.
I mean, given all of this uncertainty, is that why it makes sense to have scenario planning, so that it's a lot more nuanced when you look at the risks going
I think
forward?
this is part of our new strategy review, that we are doing this scenario analysis. We did it in the past, now we're doing it a little bit more, let me say, more intense, because we take into that now we are checking all the different all the different possibilities. And so I believe this is an important exercise, and this review was important to do because we came from a situation where inflation was way low. Then after the pandemic and this Russian war of aggression against Ukraine, we came into a situation where inflation was much too high. Now we know a little bit better how the instruments are working, and we realize that we have a rich tool that we have here available to tackle all the different situations.
Joachim Nagel there, president of the Bundesbank and ECB Governing Council member, speaking to me a little bit earlier. Now, we're also joined by Lorenzo Bini Smaghi. He's chairman of Société Générale, former member of the executive board of the European Central Bank. Mr. Bini Smaghi, as always, thank you for joining us in good weather, actually, this time. Yes, so this is a positive. When you look at trade and when you look at all of the uncertainty that central banks like the ECB have to face, what is the right way forward for them?
Well, certainly, I mean, the situation is very different in Europe from the US. I think in Europe, indeed, inflation has been brought back, expectations are aligned. Actually, if you look at the forecast of the ECB, there is maybe a risk that inflation is too low. So the ECB has to be careful not to repeat, if I can say, the mistakes of 2014, 2015, where it let the inflation come down and did not act sufficiently strongly or delayed action before getting into quantitative easing. So that's something you have to look at. On the other hand, oil price may increase, and you can have some kind of other. So life is not easy for central bankers right now, but I think the ECB is in a better position certainly than the Fed, which faces many different shocks, the fiscal policy, the trade shock. So that's I think much more complex environment to navigate.
Do you worry more about inflation going down to 1.6 instead of 2% and reaching that target?
If I look at the forecast of ECB in 2027, inflation is 1.6. And if all this uncertainty, I think it's very difficult to forecast the impact of uncertainty on consumption, on growth, and therefore on inflation. But intuitively, the higher the uncertainty, the lower is the investment that companies are going to make, and consumers are going to wait and see. So this means deflationary forces, and that's much more complicated to contrast than inflationary forces.
We were listening yesterday to the speech of Madame Lagarde yesterday evening, where she, talked also about the strategic review by the ECB. Now, to put it very simply, the idea is that instead of giving proper projections, is you have a base of scenarios. I mean, is there a concern that actually scenarios gives you different outcomes, but actually could be even more confusing than what we have now?
Well, scenario is a way to look at possible margins of maneuver. Clearly, for instance, if we go into a deflation scenario and interest rates are already very low, you're going to hit the zero lower bound, and that's a risk you have to take into account. Now, the key word in this strategic review is forcefully. The central bank has to ask. The central banks need to act forcefully. But what does it mean, forcefully? I mean, learning from the past, I have the impression that the central bank should understand that some of the actions they took in the past were not forceful enough. If I think about 2014, 2015, the deflationary impact that the ECB was facing, it started by lowering interest rate into negative territory, then forward guidance, and then only at the end QE. I really wonder whether that kind of path was the right one, whether they shouldn't have gone directly to QE without, going beyond the forward guidance, which didn't really work, and negative rates, frankly, were not optimal for the economy.
But isn't this time even more difficult, given the wide range of unpredictability when it comes to trade policy from the US?
Yes, but learning from experience and looking what the Fed, the Bank of England have done, for instance, they didn't go negative on interest rates. And in Europe, I think this certainly hurt the banking system. It prevented the banking system, it reduced profitability, so banks had to shrink their balance sheet. So actually negative rates didn't have a great impact on credit growth, for instance. And that's something that I would have expected to see. So while quantitative easing, maybe it lasted too long, but it started too late. That kind of self-criticism I'm missing a little bit. Hopefully they will learn from experience if it happens again. I mean, this kind of deflationary forces.
Do you worry about deflationary forces?
Well, again, I mean, if we face a long period of uncertainty, companies not investing, consumers waiting, I think that's going to drag down the economy, and not only in Europe, all over the world. And and if savings goes up, that's a deflationary. Other things can happen, but that's something that you can see may happen again.
We talk. I mean, we hear a lot from Christine Lagarde in Europe and the euro actually taking a bigger role, given the global imbalances and question marks surrounding the dollar going forward. I mean, in this scenario, what roles do European banks have to play?
Well, I mean, there are great opportunities in Europe. I mean, we just need to act. We need to create a capital market. We need to create a deeper market. We need to have...
Crazy we don't have it yet.
Well, I mean, everybody's committing to that, but then when it comes to taking decisions, you have the bureaucracy, the national competences, what I call, turkeys don't vote for Christmas, all those who lose power by creating a European capital market, they fight for their own survival, which is not the right thing to do right now. I think we have to look at a European banking system, European capital market, also having the courage to go for technological changes also in the financial sector. I mean, all this discussion about stable coins and, Europe sometimes is too afraid of change rather than embracing and mastering change. I think the central bank has a big role to play here, not only to regulate, but to make sure that the system is resilient and is able to supply the global system, the global financial system with assets that are in euro, are stable and are liquid.
Yeah, we saw Bank of Korea actually yesterday, stopping some of the experiments with stable coins. Do you think Europe should go ahead and do it properly?
The digital currency, because the digital currency, frankly, is it's going to be used by retail. It's not going to be. I think the stable coin is a technological innovation which is huge, and it's going to be global, and will allow people to really transact without cost immediately. So it needs regulation, it needs support, and if European banks won't do it, the American banks will. So again, do you want to be in the competition and be there? And regulate because you need to regulate and to supervise, but in the end you have to take some investments to enter these new businesses and not letting it only to your competitors.
Lorenzo, Bini, Smaghi, thank you so much for joining us today. That was, of course, the chairman of Société Générale and former member of the executive board of the European Central Bank. Now, coming up a year after his landslide election win, the UK Prime Minister Keir Starmer is under pressure as he faces a revolt over plans to cut welfare spending. Details next, and this is Bloomberg.
The level is not the problem. I think that this is perfectly, acceptable according to our projections. Here the question is, that we should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, is not something that we cannot. We can overlook a little bit. Something beyond that, it would be much more complicated. But 120, I think that is perfectly acceptable.
That was Luis de Guindos, Vice President of the European Central Bank, speaking to us a little bit earlier. Now, the UK Prime Minister Keir Starmer working to contain a rebellion in his Labour Party ahead of a vote on his flagship welfare policy. Now, the bill has provoked widespread internal criticism and cast doubt over Starmer's leadership. Well, we're now joined by Ruth David, our London Bureau Chief. Ruth, good morning. So, great to speak to you. How likely is the bill to pass, and how close could it be?
Good morning, Fran. Love your new office. Now, in terms of the bill passing, it is still too close to call. We just had an update to our story that said about 39 Labour MPs have signed a new amendment at sinking the bill. We're hearing in other media, and we're hearing from us as well, that that number is between 40 and 50. And we don't know whether that number could rise to about 80 that they need to sink it by the evening. So the vote is expected at around 7 p.m. and there'll be a debate in the House of Commons starting at lunchtime. So there's still a lot of way to go, and there's furious back-channel negotiations going on to ensure that this bill passes, but it's absolutely too tight to call right now.
So what does it say about Starmer's position, but also the position of his Chancellor, Ruth?
It's a really grim anniversary for Starmer, who came in last year with, a 165 majority, this huge win for the Labour government. And then there's been a series of missteps and backpedaling. So we estimate that the Treasury will have a loss of about 4.25 billion from this and the backpedaling that they did on pension reforms. And we're talking about all of this, even if the bill goes through. There's so many other challenges. The Chancellor, who promised not to raise taxes, who promised not to increase borrowing, is seeing all the other measures that they're trying to put in place being stymied by their own party. So I think for both of them, even to get this through is not going to be the end of a long road ahead and plenty of struggles. But we still got 4 more years, so let's see.
Let's see, indeed. Ruth, thank you so much. Ruth David there, our London bureau chief, with a terrific briefing on some of the rebellions, of course, that we could see this week. Now, let's also bring you a Bloomberg scoop. We've learned that Apple is considering using artificial intelligence technology from Anthropic or OpenAI to power a new version of Siri. Now, it's a move which would sideline its own in-house models as it looks to turn around its flailing AI efforts. Now, for more, we're joined by Peter Elstroms, Bloomberg's executive editor for global technology. Peter, congratulations to you and the team for this really, really incredible story. So why is Apple doing this?
Yeah, this is a Bloomberg exclusive, as you say. Yeah, so Apple has been struggling in AI. The company, of course, is known for its cutting-edge technology, for its ability to integrate hardware and software and put them together in these very elegant packages that, we all spend $1,000 on. But in the case of AI, they've really fallen behind. Of course, we heard about Apple Intelligence last year. We've heard about some of those details. But now what we understand is that they're talking with OpenAI and Anthropic about possibly using their AI technologies in the iPhone in particular. What they've done is they've had talks with these two companies and they've asked them to try customizing their LLMs, their models, to be able to run on Apple infrastructure and then use them with Siri and offer these products to customers. At this point, the talks are still quite early. They're still experimenting with those two different models. Internal tests so far suggest that Anthropic is quite attractive to them, but they also have an internal effort to do their own AI that they're still working on. They plan on introducing these technologies sometime next year.
How will Apple's AI team actually be impacted?
Well, this is a big deal for them that their leadership has decided they have to look outside the company. So, big picture, this is a tremendous setback for Apple that they're struggling to catch up in AI. If you believe that AI is very important technology, a once-in-a-lifetime technology, as some have described it, then you need to believe that you have to be at the cutting edge of this, and you have to be able to deploy these services to offer them to your customers. And for the internal teams that have been working on this at Apple, they have been struggling to catch up with the leaders, particularly OpenAI, Google, Anthropic, and some of the others out there. Of course, there are a lot of Chinese competitors out there. And the important part, I think, for the Tim Cook and the leadership team, they realize that they can't fall behind in this technology. They need to figure out some scenario, whether it's using some of these outside vendors or whether it's doing it internally, to be able to catch up with the leaders and incorporate into the iPhone and other products AI technologies that's really cutting edge.
Peter, meanwhile, Meta has announced it's developing an AI super intelligence group. So what's the purpose of that?
Yeah, it's interesting. We're seeing a lot of big moves from big tech around AI. There's a lot of jostling to get into places where they can actually have leadership positions. It's not just Apple and Meta, it's Google, it's many of the others too. So in Meta's case, we had Mark Zuckerberg, of course, spent a lot of time investing in the metaverse and what he thought was the next big thing a few years ago. And now he's pivoting very hard into AI. What we heard most recently is that he's been recruiting this team for superintelligence. They call it the Meta Superintelligence Team. They're trying to recruit a lot of talent from the outside. They announced 11 of these people just yesterday, including the leadership team is going to be headed by Alexander Wang, the guy who had been at Scale AI. Meta invested $14 billion into Scale AI, and they took the CEO on to help lead this team. In addition to him, this guy who used to run, Nate Friedheim, is going to also help run the group internally. He had been running GitHub in the past. So those two are going to kind of guide the AI efforts of Meta as they try to catch up and they try to also compete with OpenAI and some of the others out there.
Peter, thank you so much. As always, Peter Elstrom there. Terrific briefing. Peter, of course, manages our global technology. Now, also making news, Boeing says its chief financial officer, Brian West, is stepping down. Now, West helped orchestrate one of the biggest capital raises in U.S. history last year to steady the plane maker. He will leave in August to be replaced by the former Lockheed Martin executive, Jay Malave. Now, Standard Chartered is reportedly facing a $2.7 billion lawsuit over the 1MDB scandal. The Financial Times says liquidators have filed a claim in Singapore, which argues that the bank failed to conduct the anti-money laundering checks required of it. Now, the bank has told the paper that it will vigorously defend against any lawsuit brought by liquidators. And European bank stocks just completed their strongest first half since 1997, and in doing so extended what has been a golden run for the sector. Well, we're joined now by Paul Davies from Bloomberg Opinion. Paul, thank you for being with us. Have traders, what stood out in the first half?
Yeah, thanks, Francine. So it's they've performed very well, obviously, as you say, and a lot of that is down to interest rates remaining higher than expected, and also the trading environment has been incredibly strong. Ever since we saw the Liberation Day kind of tariff war throw markets into a bit of chaos in April. There was some kind of concerns then that traders might sit back on their hands, investors might sit on their hands a bit because of all of the uncertainty involved around how that would develop. But in fact, that's continued to be very strong. Now, investment banking had been quite weak, and even only at the start of June, a lot of the executives were talking at various financial conferences and being quite cautious about the amount of fees, about M&A activity and so on that we would see. But as the quarter closed, everything has turned out better than people expected, I think. And we had a story yesterday about how global M&A in the first half finished with about $1.8 trillion worth of deals, which I think was the best first half in about 3 years.
So Paul, have traders effectively bailed out investment bankers?
Yeah, to a degree, yes. I mean, as I say, the investment banking side did recover as the quarter went on, and especially in just the last few weeks. But trading has been particularly strong.
So, going to some of the deals, why is BBVA going ahead with its bid for Sabadell when the government is so obviously against it?
Yeah, well, this is very interesting, actually. I mean, a lot of the consolidation that we're seeing in the sector is kind of running into difficulties. There's a lot of political opposition. I mean, especially in Italy, it's been incredibly difficult, and it looks like the whole complex of deals there is going to hit a bit of a stalemate. BBVA has always said that they were confident that they would be able to achieve a lot of the cost savings, a lot of the kind of synergies, especially on the IT side, with or without the ability to fully merge these two banks. Now, the government, in a pretty political move, has turned around and said you're not going to be allowed to merge Sabadell and BBVA for at least 3 years. But as I say, they're pretty confident they can get the savings anyway. So they've decided to, I think, go ahead with the offer.
Is the rest of the European banking consolidation over, Paul, before it's even begun?
Yeah, well, this is going to be an interesting question. I mean, especially in Italy, we've got, a lot of political opposition, a lot of, conflicting interests, people competing against each other to try and get influence over. I mean, ultimately, Générale, the insurance company, is kind of at the center of a lot of this. But the biggest and most surprising sort of development, I suppose, in the last couple of weeks is Brussels and Italian authorities starting to look at the original share sale, or the most recent share sale for Monte dei Paschi, where some smaller investors managed to get some pretty influential stakes. And now there is some, suspicion or concern that perhaps that share sale wasn't done correctly, and some of the bigger banks that bid or that wanted to bid, such as UniCredit, didn't get the proper opportunity to try and get the stake when it was put up for sale by the government.
Okay, Paul, thanks so much. Paul Davies there on some of the banking stories we're covering today. Paul is from Bloomberg Opinion. Now, a couple of currency moves. Look, the euro is hitting a new high versus the dollar at 118, so it's extended gains rising some 0.3%. We'll, of course, talk about foreign exchange at 2:30 p.m. London time. We'll be hosting a policy panel with the world's top central bankers. We'll have all of that live on TV. Terminal users can also get commentary and analysis on T Live Go. Up next, Bloomberg Brief, and this is Bloomberg.